Good evening, everyone. Evening. Good evening. Okay, so I hope everyone had an excellent day of trading today, and we are in here today to talk about the third phase of the Orderflow learning series, which we started off 1.5 weeks back. First and foremost, it's a good Friday, and I hope everyone who was on the long side has had a spectacular day today. The icing on the cake was that last 1 hour move, right? That last 45-minute move, which broke the market to a new high. And yeah, that's what is going to happen with the market at all-time highs. The new all-time highs are going to keep coming, right? What we're going to be talking to you about is basically, the use of order flow in trading. And order flow is, like I've been mentioning to you, is demand and supply. It's evidence of a market moving up or moving down. You know what really happens, with us as traders, we try to run ahead of ourselves and we let our thoughts, our belief systems, and our feelings of greed and fear ruin opportunities for us. And I'll use that word again, ruin opportunities for us, right? So this is what happens. And if you've not been able to capitalize on a day like today, it's just you have to look inside of you and you have to understand, actually, what went wrong? What were your limiting beliefs which came in the way of you putting yourself up ahead in front of a fantastic opportunity of trade today, right? The trend is clear. We are moving up. We are at all-time highs. But what is stopping you, from capitalizing on the momentum of the market, right? Why are these thoughts, coming in the way of you magnifying, those opportunities, which are so clear, to all of us over here, right? So what we do is we work with the evidence of an order flow chart. An order flow is nothing but the demand and the supply side of the market to keep it clear for us in terms of our objectives about what the market is doing at every point in time. So now we move from no longer a thinking, which is there in our head, or a feeling, which is there in us, in our hearts, but we move, to a more process-driven environment where we are looking for incoming data. And as long as, you can surrender, to the fact, that information is the biggest driver to markets, and information of existing buyers and sellers in the market. As long as, you can surrender yourself, to that thought, that there are other traders like me in the market who are taking care of this opportunity. And some of these traders have been years in the market, and they have got excellent systems with which, they are trying to assess what the market is going to do. And if you can bring yourself around, to identifying who these traders are and work alongside them, and I'll repeat that word again, alongside them, not against them, you will make the most out of the trends, which are coming in the market. Now, I'm not saying specifically, that the market is going to be in an uptrend all the time, but you'll take advantage, when a market is going down also. Right. So as we go dig deep into our session today, we're going to be starting off with a small review of what we've been speaking about. And in our very first session, I told you, think of order flow as just two words, demand and supply. And at every point in time, through the opening of the day at 9:15 a.m. right up till the close, every 3 minutes, every 5 minutes, every 30 minutes, whatever time frame you're thinking about and you're trading about, you have to ask yourself this question: is D greater than S, which means is demand greater than supply, right? And you look for this evidence, in the order flow chart to find out exactly, that part of the equation. D greater than S, that means the market is going to go up, demand greater than supply, or supply greater than demand, or S greater than D, which means the market is going to go down. So in the past two sessions, we've had classic cases of D greater than S, which is why, the market is on the higher side and probing higher, right? Now, in that was session one. Then in the last session, which we had on order flow, we spoke to you, about market orders, and I did make it a point to mention to you that market orders are you booking that flight or booking that train, that tatkal ticket. You are in a hurry to go and you want to go now, right? So that is by definition a market order, one who does not want to wait, one who wants to board that flight, one who wants to board that train immediately. And he's very clear in his head that he wants to go from point A to point B, and he wants to get out of point A and onboard it onto a train and onboarded onto a plane because okay, he has a destination in mind. Those are what we define as market orders. People who are in a hurry, who are not wanting to wait, and who will pay a slight premium. That means they'll pay at the market to get themselves ahead and ensuring that they have a seat onto that train or onto that flight they are thinking about boarding. That is a market order. The limit order is you making your vacation plans, right? So you are decided to go on a holiday with your family, with your friends, or on any trip 1 week from now, 1 month from now, 2 months from now, 4 months from now, and you're planning. Okay, you've got your itinerary sorted, you have your tickets booked, and you decided on a certain date, and you also decided that you're going to be traveling on that date, right? So that's your limit order. You are waiting for a particular event and the market to come to that particular event, and when the market hits that, you onboard and you pick up that flight on that particular date. So your market order would be somewhere above or below, by any length you choose, above or below the current market price where the market is trading right now, right? So if the market is currently at about 21 550 560, your limit order could be 21,600, or could be about 21,450. You're waiting for the market to come to that level so that you get a fill. Now, by definition, we spoke about market orders as the movers and shakers of the market, and we said in the last session also that if we keep tracking them, okay, and we find out what they are doing, they will put you ahead in the major moves of the market, because they have a plan and they have a strategy for that, to get to accomplish that plan. So these are the kind of traders we want to work with. So that's why identifying a system where we have a market order in the chart, an order flow chart, we have a market order identified, and we work with that market order or with those traders who are part of that market order, and we board the train along with them. We get a good chance of going to the destination along with them, right? And we also said that our process of identifying these market orders were your initiative buyers and initiative sellers, right? So as long as you could find out which the initiative buyers were, where the initiative buyers were in the market and where they were, and as long as you could trade alongside them, you had a chance to be a participant in the plan they had as traders. Just wait, they know what they are doing, you ride alongside them. That was the concept of it being with the initiative buyer and being with the initiative seller, right? And finally, we spoke about what are called zero prints. That was at the fag end of that last session we did, and we spoke about how these zero prints are telling us if the market has got no demand, or if these markets have got no supply. And we said that we will use these zero prints to put stop loss orders for our existing orders in the market. Okay, so zero prints, by virtue of them being zero prints, told us that the market does not have demand or supply at that particular point in that bar. So instead of putting a random stop loss, at a 35 or a 40 or a 42, we identified that particular point in the bar where the market had put in a zero print, and we knew that the market was not having demand or supply over there, and that's why we chose that point as a stop loss point, right? So these were the two principles we spoke about last week, and today we're going to carry forward this discussion and look into other aspects of order flow. Now, I'd like to mention very clearly over here that order flow is not a simplistic tool. Why? Because the market is not a simple being. The market is not a simple unit, right? Anybody who comes and thinks that it is easy to make money in the market and that the markets are a simple mechanism which are going to give him money in and out every single day, you got a wrong impression and you walked into the market with a very wrong expectation of what the market is. It's not going to work for you, right? So the markets are complex, and we say that with complex things, you've got to have more than one trading strategy, and you've got to have more than one method of approaching that market. The simplistic idea of approaching every single day with one strategy and thinking that the market is going to work in one particular way every single day is long outdated. It's no longer relevant. The markets have become fast. and the markets are changing every single day, and you got to have strategies, okay, to match up, okay, with what the market is doing, right? So a complete no. We are not traders who think, okay, that the market is a box and every single day, okay, you have to, okay, trade alongside or in that box, right? Okay, trade, okay, what you understand. We agree with you on that, but okay, don't think, okay, that it is a simple unit and okay, and there's only one strategy which is gonna work over here. So which is why, along with the IB and the ISSs and the zero prints, okay, we have, okay, other aspects of order flow which we look at, and we're going to be doing a deep dive in them today. And those ones are your VPOC, which we call the volume point of control. We are also going to look at something called COT, which is the commitment of trade but of a bar, and we're going to look at it bar, one bar at a time. We're going to look at the VWAP and how it is important, and not just the VWAP of the day. We have the VWAP of the bar also, the trading bar, and that's also, okay, very important for us, okay, to look at. Then we're going to be looking at how the open interest plays a significant role along with the volume, okay, which is there of that bar. So we're going to be talking about all these concepts. So before I go onwards, I just wanted to quickly, okay, bring your attention for a revision, okay, of what we discussed. So today's session, in today's session, this is, okay, the IB. We spoke about this being a large market order. And if you have any ordinary chart also, if you go back to about 115, the market changed at 115 today. And it got a lot of huge, big demand coming in at around this 21,420, 440 zone. So there were these big, deep-seated buyers, and I'm going to be talking to them. We call them LLTs, large lot traders, and we'll touch on them, okay, as we go into this program. They came in and they changed the complexion of the market. They absorbed all the supply and they added new demand, which is why, okay, half an hour later, okay, the market, okay, took off to about 21,590 by the close, right? So this is, okay, what we saw today. And just to bring your attention back to what we were discussing last Tuesday, we were here together when we discussed, okay, this particular order flow chart. And I think it was a Tuesday evening when we were discussing this particular chart on your screen right now, right? And we were live together in the evening, post on Tuesday at 5 p.m. And this is where the market closed on Tuesday. And if you recollect, I told you, okay, on Tuesday that the market, okay, was dominated by an initiative seller at the close, and he had come in at about 21,064 on Tuesday, the 12th of December. And subsequently, the next morning, the market, okay, opened up below this IS point. So what did I tell you, okay, about initiative buyers and initiative sellers? We spoke to them as aggressive market orders. For instance, okay, not just this 1,049, there's a number of sellers below this also, and they were all constituted and made an impact in this particular bar. Okay, now for next day trends, I go with a 30-minute bar of the market. Okay, so a lot of us, okay, when we are looking for action, okay, and we're looking to add or build trades, we look at a 3-minute bar. But to recognize a trend, you have to, okay, work with a 30-minute bar. And I feel that the entire concept of market profile, it's not just me feeling, the entire concept of market profile has been built on a 30-minute time frame. And it works perfectly, okay, fine for us, and we are comfortable with working on a 30-minute time frame to identify the trend, right? And if you look at what is happening in the markets these days, the dominant trend via the options market is actually a 5-day event, right? So the money flows, okay, let's say into a Nifty, which has got a settlement next Thursday. The money flows in on a Friday and it leaves, okay, on a Thursday for that weekly settlement. And then, okay, again the next Friday, okay, the money flows in. Okay, if you track option flows, this is, okay, where the money is. And you can find that out, okay, by looking at the next month charts also. So if you look at all the option chains and all the option tables, you will find, okay, that the money is predominantly in the front month. Okay, so this is 21st December right now. Right here, we are trading, okay, the 21st December, and you'll see, okay, these volumes, okay, which are coming in at 21,450. the one in orange is the number of contracts, okay, of this volume. So that's about 27,62,000 contracts traded at about 21,400 call strike today. And then on the put side, okay, you'll have this, okay, 34,80,000 contracts traded at 21,300 put, right? So this is the kind of money, okay, which is coming in the 21st December. But have a look at what is happening, okay, at the 28th of December. So if I go back to 21,300, the 212, okay, it's still, okay, large, okay, for this thing, but shows, okay, it as a base, but the same kind of volume is not there, okay, in the front month contract, which tells us that all the money is there in the front week contract, and money flows from a Friday to a Thursday for the Nifty. It flows, okay, from a Thursday to a Wednesday for the Bank Nifty. So it makes sense to track this as a 5-day cycle, and the best way, okay, we get around, okay, to tracking it as a 5-day cycle is to study the trend in a 30-minute time frame, right? So back, okay, to that chart on Tuesday. I just want to, okay, go through this quickly, okay, with you, and we'll go into this session. So we spoke, okay, about that particular IS, okay, which came in, initiative seller. On 12/12, right? This is, okay, where it was 21,000. The next day it opened below 21,040. It met one more initiative seller, okay, at 29.67, and this was that last big signal before the turnaround. Now there was no buy signal till this initiative seller was there in the market, right? But what really happened subsequently, okay, this IS signal got cancelled out, okay, by a new IB signal. So what did I tell you, okay, when we were discussing, okay, about finding these IBs and ISSs? I told you, okay, we'll talk about it in 3 points. So one is, okay, the most recent signal is the most dominant one, okay, that's number one. Number two is we spoke about the rule of 10. That means, okay, a particular signal on any time frame is valid for that time frame multiplied by 10. So that's 30 minutes multiplied by the rule of 10, which is about 300 minutes. So any particular signal is valid for 300 minutes in a 30-minute time frame. And we also said that if there is one signal and if there is another opposing signal which comes up in the next 300 minutes or anytime in the next 300 minutes, the most recent signal is the one, okay, which takes valid. So these sellers got negated. They were late sellers in the market. There was a new buyer came in, and we took 29.21 as a reference, okay, for this buying. So late into that close that day, there was sign, okay, that there was a lot of buying coming in, especially, okay, as the market, okay, hit its way to about 21,040, and this was all order flow. And I'll talk to you, okay, about what to look for in this COT. But if you look at this COT also, these are very high readings, okay, right at the close. And it told us, okay, that this market, okay, wanted to gap up. So next day, okay, was an event. And into that event, we saw a lot of buying coming in at the open, right here, okay, there's a lot more green coming in, and the COT itself, okay, is about 6696, okay, which is the largest number, right? So we are not yet spoken about the COT, but I'll talk to you, okay, about what the COT can do. But into the open, what we really look for in a higher open is the presence of more demand, okay? And if we see more demand, okay, we know that the market wants to probe higher or go higher. So into the open, we saw this demand and we knew, okay, that the market was going higher till we reached a point where we got one more IB. Now this came again just as that rule of 10 was getting extinguished. It came at 1:15 p.m. and then there was a new support built up at the market at 21,280, where we saw a bunch of greens again. So this IB became the most recent signal on 14/12, which was yesterday, and we worked, okay, with 21,280 as a support going forward, right? So this was, okay, yesterday, and then at the open today, 15/12, we had another round of buying coming up over here in the A and the B period, and that was enough. Okay, once this, okay, buying was established, the market pulled back, okay, saw, okay, that this demand, okay, was holding, no reds, okay, came in over here, and that was enough, okay, for the market, okay, to launch itself back to about 21,433, which were those day highs, previous days highs. But at 21,333, there is another IB, just, okay, when that rule of 10 was getting over, again at 115. The previous signal came at 115. That was the rule of 10. Now the rule of 10 was coming to an end. So we got ourselves a new buy signal based on the order flow. 21,421 IB became our new support, and the market got subsequent buyers and launched itself up into the close. So this is a simple read of order flow. And if you can read this market, like how I've been talking to you about, ignore all the noise, focus on the message, which is coming into a 30-minute time frame to find out the trend of the market. Never bet against the trend of the market. Find the trend to the 30 minutes, and then to execute, you can go into your 3-minute time frame. So now that that 21,420 has got buyers, you go into your 30-minute time frame, your 3-minute time frame, and you look to see if there are buyers coming in around that 21,420 zone. So this was that IB signal which came in, and this on a 3-minute time frame is enough for you to launch yourself into a put. So you're going with the trend. There's another buy signal which is that same buy signal which is there at 115, but a further confirmation of it came today later at 21,441. And when you got these IB bars, and you're shorting calls or you're buying long puts, you're making a very, very big mistake, and the market is gonna give you a lot of pain if you do those kind of mistakes and go against the flow of the market. Generally, when these kind of IB bars come, the market finds support at the lows of those IB bars, and then the market proceeds to go upwards, right? So this is the message based on understanding IB, IS, and structure and trend of the market. Now today we're going to go a little bit more deeper, and we're going to be talking about a few more things which are essential in understanding the way to collect the information from an order flow chart. But remember, what did I say about order flow? I said order flow is feeding us information about demand and supply, right? It's just telling us what the market is doing and whether demand is greater than supply or supply is greater than demand. It's up to us to read this information and to monetize this information, right? And when you can monetize this information, you have a smiling account which works with you, right? So one of the first things we look at is we like to see what is the commitment of traders within a bar. So this is where we look at this figure called COT, which is the commitment of existing traders, and COT is bar specific. So the best way to look at COT is to look at a COT of about a few bars in a row, because I'll say this again, one bar does not make a market. Even though if it is a daily bar, or even if it's a 60-minute bar, or even if it's a 30-minute bar, one tiny bar of 30 minutes is nothing against a huge micro sim, a huge organization, which is called the market. It's just a very, very small integral part of it, right? So when you're looking at COT and trying to understand demand and supply, try to look at the last 4 or 5, 6 bars. Now I get a lot of traders who work on a 3-minute chart, right? And they look at a 3-minute chart, and all they are focused on is what is happening in a 3-minute chart. The 3-minute chart is just that, a 3-minute version of a 375-minute day, right? A 3-minute bar is just a 3-minute version of a 375-minute day. And if you're going to start extrapolating what is happening in a 3-minute bar and find out that this bar has got large COT, or this bar has got huge delta, or whatever you call it, you're going to find yourself in a very bad situation in the market, right? It's one thing to find aggressive market orders, but when it comes to recognizing the entire activity, which is those limit orders and the market orders, and by the way, COT is a sum of limit and market orders, right? So all those market orders and all those limit orders come in a COT, but the best way to understand COT is to look at about 5 or 6 bars together. What I do is I look at COT in terms of a 30-day event, every single bar telling a story, and about 5 or 6 of those 30-minute bars are enough to tell me whether the market is liquidating, or the market is adjusting, or the market is booking profits, or the market is finding itself new demand, right? So just here at 220, it was not just an IB signal for me, but even if this IB signal was not there, I saw this COT of 2720 and 1872, and this was enough to tell me that there was high demand coming into this market. And just a few bars earlier, there was not that demand, that 413 and 432 had come, and this 560. These are very small numbers, of a 30-minute bar. The minute it starts crossing 2000 and 3000, then you know that there is something happening. But these are numbers which will get printed anyway, like 25 and 400 and 300, because the market is moving and there are orders coming in at every single 30 minutes. So look for those big quantities in COT. And even if you do not get an IB signal, if your COT is huge plus, you know that there is now new demand in the market. And when there is more demand in the market, you have to build yourself into long futures and long calls, right? And if you're shorting calls and if you're buying puts based on this, you're going to find yourself quickly out of the market, because the market is not going to be kind to you, right? So here is the thing, you work with what the market is telling you. Here is the thing, that you work with the information the market is telling you, and the better you get at picking up this information from the market, the faster you're going to get to understanding what the market is all about, right? So let's move on and we'll discuss a concept called LLT. LLT is simply large lot trader. LLT is large lot trader. So to us, it means it's a institution. It cannot be definitely retail. It's an institution who's come in a big size in the market. And it knows that it wants to do a certain thing, or it's trying to adjust an existing position in the market. So just like market orders, which tell us that these are individuals who have decided and have a pre-decided plan of going from point A to point B, the LLT is a structured institution who's created a structured product, who's maybe levering up or adjusting his position size or whatever he's doing. But when he comes, he tells us that there is something else happening in the market, and he's large enough with his size to take out existing demand or take out existing supply in the market, right? Whether you like it or you do not like it, the market is a game of might rules. It's the rule of the strong, right? So your 200 lot trader is bigger than a 2 lot trader and has got a larger size with him to move the market. He's got larger pump with him, and he's got a bigger drive to have an influence on market direction by virtue of his size. A 2 lot trader will not be able to move a market that much, right? So what we do is, like, we always keep looking out for these traders who we call as LLTs, large lot traders, and when they arrive, we know that these are the traders who are booking profits in the market. So something like this, what happened today, the last 2 days, we've been seeing a lot of these traders come in the market. Something like this, anything above 1000 quantity coming together is a sign that these traders are there, and they started booking as the market went up to about 21,564, right? So this is of course the last 15-minute adjustment. I don't want to spend time over there, but these guys came in here and they started booking profits around here, and for them of 120 130 point move for the size which they are trading. So 1048, or say about 1000 lots times 100 point move and times about 75 rupees per point of move. You do the math, that is enough for them to have made a profitable trade in just about 1 hour of trade, 2:45 to about 3:45, 1:45 to about 2:45 p.m. Right? So it is that. So you trade yourself with those people who are holding a bigger size in the market, and work with these people who are having the bigger size in the market, large lot traders. Now I should quickly add over here that not all large lot traders are directional traders. Not all large lot traders are directional traders. So if they are buying something in futures, they could be buying it to hedge a position which they have in the equity market, a short position, or they could be buying it and having a short call position in a stock or even in the index as a hedge against that position. So it's always a structured product. It's not a stand-alone directional trade. So I want to be careful, okay, in understanding it. In the global scheme of things, most institutions, okay, will not put large orders without a hedge. Very few, okay, will take a large directional, okay, 5,000 point or 5,000 lot order and not put a hedge to it, because institutions, okay, believe in the value of return, and for them, okay, that 7, 8, 10, 12% is good enough for them. And because, okay, they hedge and they protect, okay, their downsides, okay, that's why, okay, they can have the advantage, okay, of those kind of returns coming to them. Right. So not all LLTs are directional traders. You have to, okay, make a note of this somewhere, that they can be hedge traders also. So just be a little bit careful when you are understanding about LLTs. Right. Which brings me, okay, to the topic of VPOC, or volume point of control. Right. Now, volume point of control is simply this: the yellow horizontal bar in a chart, in a 30-minute bar, right? So all those ones, okay, which are marked in yellow are what we call the volume point of control, and all these little green ones over here are the VWAP of the bar. So we have the VWAP of the day, which is this green line over here, but in all these bars, okay, sometimes, okay, you'll have the VPOC and the green one together. Every time, okay, you see a green line, that's the VWAP of that particular bar. So you can, okay, keep track of where the buying and selling happened, okay, by choosing the VWAP of the bar also. Okay, but our specific attention today is going to be on the VPOC of the bar. Now, what is this VPOC? And I wanted to carry this, okay, definition with you. VPOC is simply means the largest concentration of volume in a bar. That's the simplest definition of VPOC I can give you. The largest concentration of volume within a bar. So if you're good at maths now, and you're looking at this particular bar, which is there on your screen, from 21,564 to about 21,454, roughly about 110 points. And the VPOC here is 2321 and 1198. And those are the bars, okay, on the left and the right. And if you can quickly sum up all of them, like your 1270 and 471, 1546 and 764, 1080 and 845, you'll find out, okay, that this particular zone is got the largest concentration of volume. Now, why is this important? Because we immediately come to know within a bar where the market has got the largest kind of volume which is coming in. Right, and based on this information about where, okay, we know the largest concentration of volume is coming in, we get to know which of these traders are profitable and which of these traders are what we call upside down, or, okay, having a losing position. Right, now what really happens is, say for this particular bar, okay, we had, okay, these big LLTs, and this VPOC, okay, was right here around 21,420. Now these guys, okay, have, of course, okay, have a strategy and a plan, and they establish themselves over here. If the market moves up, do you feel, okay, that these traders, okay, will feel confident and reassured because their position is winning? Right, they are buyers, they are in green, they are buyers, and the market, okay, is favoring them, so they will be comfortable and they will be in profit. So what we do is we always watch what is happening at VPOC, and we see whether the largest concentration of volume is profitable or not. And if they are profitable, if the largest concentration of volume is profitable, then, okay, we know, okay, that those traders, okay, will hold their positions. But if the price goes against them and this largest concentration of volume is not profitable, then, okay, we're going to have a situation where the market is going to start winding up against them, and we will have, okay, so a situation, okay, where it goes against them also. Right, so 21,420, okay, was the buyer. We had, okay, these buyers, okay, show up, and we saw, okay, that these people, okay, came in over here and they saw, okay, that this, okay, became a place, okay, for them, okay, to build, okay, positions in the market. Right, so this is, okay, 21,420 in the futures, and these longs, okay, became profitable, and they established a position for themselves, and they became profitable because, okay, the market, okay, was in favor, okay, of those positions which were given to them. right? But what if the market, okay, had gone against them? Okay, we could have been in a situation, okay, where it could have been different and it could have gone against them, right? So that is VPOC. Okay, now I'll just pause over here because, okay, we've spoken, okay, about 3 or 4 concepts. If there are any questions, okay, do let me know, okay, via the text chat, and I'll see, okay, if we can work, okay, to a situation, okay, where okay, I can be in a position to answer your questions also. Any questions so far, guys? Okay, so looks like, okay, everyone is good, and we basically, okay, gotten ourselves, okay, where a good understanding of what the order flow is all about, right? So just to, okay, sum up what we've been speaking about, we are speaking about order flow as a combination of a number of things, okay, which go on in the market at one time. So one is, okay, market orders. One is, okay, knowing, okay, where these market orders, whether they are upside down or whether they are in a advantageous position to themselves, and we identify them with IBs and ISSs and RBs and RSSs. Then, okay, we find, okay, areas, okay, where the market has got poor demand or supply, zeros of demand and supply. Then, okay, we also find out, okay, whether, okay, the market, okay, has got good caught in a series of bars leading to an event. We also find out if the market, okay, has got traders who are upside down at any point in time by looking at the VPOC of the bar. Right now, just to sum up, okay, what we've been discussing, the final thing in order flow trading, it would be about your open interest. Now, I know, okay, a lot of you, okay, are already experts in open interest, so we will not really, okay, go strongly into what the open interest can do. But what we've noted is, because, okay, the large number of traders in the market, okay, are big believers in what the open interest is. We have the open interest in all our order flow charts printed in this row at the bottom. So I'll just, okay, put this banner off. Right. So that banner is gone. You can have a look at this last row now, right over here, which gives you the OI and the DOI. Now, DOI is your developing open interest. Now, this tells you what the market is doing relative to the order flow of the bar. Now, the order flow and open interest are two totally different concepts. We still do not get real-time open interest information. It comes, okay, from the exchange, and it's generally, okay, between 2 and 2, about 4 minutes on an average, okay, about 3 minutes of delayed information comes in, which is also dependent on the clearing house, okay, confirming those orders. So nothing, okay, which you see in open interest is going to be cleared till it's about 5 p.m. When all the clearing houses are done, okay, with their transactions, and they accept those transactions, and that's when the open interest is finalized post 5 p.m., which is post market. But if you watch over here, you can quickly, okay, know, okay, when the COT is high, COT, commitment of traders, green, and when the order flow is up. Now, this tells you, this is another way of looking at this market as having added new demand. Okay, so COT would mean, green would tell you, okay, that there is a lot of buyers coming into this market, and open interest going up will tell you, okay, yes, okay, what the open interest does is price moving up, open interest up means, okay, there is new demand coming into this market, right? So that open interest equation can be validated, okay, by your understanding of order flow, especially, okay, the COT. So what it will do is, instead of looking at this entire bar at the close and say, okay, this is a daily bar, and at the end of the day, you say this open interest, okay, was 267,000 contracts at the start of the day. It's about 274,000 contracts now. That means 10,000 contracts are added, but you don't know, okay, where these contracts got added. Right? It could have been added anywhere, okay, between the high and the close, and the open and the close, and the high and the lows. But with the advantage of an order flow chart, you now know specific areas, okay, where this open interest got added. So I know for sure that 21,420, because okay, the open interest went up and this COT is green, these are long buyers who have come into this market, and 21,420 is the zone, okay, where this open interest shot up. Right? So next time, okay, you find out, okay, somebody asks you where, okay, the Nifty had a large buildup of open interest, you quickly open up your open order flow chart and you find out, okay, where the open interest was built, and you tell him, look, okay, I know, okay, that there was a big increase in open interest, but here, okay, 21,420 is the point at which the open interest was built, right? And you can, okay, see also here that there is an open interest built up in this bar, and you can say that 21,372 was the point at which the open interest was built. So now you've gone. So I'll just pull that chart back up, showing that open interest. Yeah. So this open interest, okay, was built early in the morning at 21,320, because okay, that is a lot of green over here, and there's a rise in open interest, and the COT is 3,000. So you can say, okay, that this is long in the market at 21,370 level. So what you're essentially doing now, okay, with the addition of order flow and open interest, is you're taking the guesswork out of your open interest analysis, and you're no longer doing a guesswork of whether they were buyers or sellers. You know confidently using order flow that those were buyers. And then if they were buyers, you're also knowing the point at which, okay, they bought the market, right? So somebody, okay, will tell you, okay, that the open interest was high, okay, between 20, the open interest, okay, was high today between 21,560 to 590 and 21,354 of a day, okay, which had a range, okay, of these many number of points. But what point is that information? Okay, in a 200-point range, okay, you cannot just say, okay, that the open interest was high. You have to know, okay, at which points the open interest was higher, right? Now this is very useful to us when we look at everything in terms of the option settlement. So we look at option contracts. We look at option contracts, and we look at order flow of an options contract. And on a Friday, there isn't a lot of open interest, okay, being added. But as we go into Thursday, one of the things, okay, I'm extremely focused upon is this COT value and the open interest. So these last three rows for all option trades, I'm extremely focused upon, because especially after 12:45 p.m., this, okay, tells me immediately, okay, where, okay, the open interest is rising, and where, okay, the open interest is getting cut off. So open interest, okay, going away from a strike, okay, will tell you, okay, that they are covering positions, and the COT, okay, will tell you that those positions are being covered, and now the market, okay, has got a run to the upside, right? So here, okay, before this move, the 21,300 CE was already, okay, covering positions. Even the open interest, okay, was showing, okay, that they were covering, right? But what you want to see for a buildup of open interest is of showing writers is that this COT, okay, will be red, and this DOI will be green, right? Now remember what I'm saying over here. On a settlement day on a Thursday, if you want to know how many writers are there in the market, you will look at the COT, and the COT, which shows you buyers and sellers, will be red in color. That means, okay, there are more writers. And a confirmation of that, okay, will be your DOI, which will be in green. That means, okay, there is an open interest build up in the market, right? Now, if there is a covering of that open interest, if there is a covering of the open interest, okay, is going to go from addition to reduction. That means from green to red. And the COT, which showed writers, okay, will start going green, which means there are buyers, which means the writers are covering positions, right? So I hope, okay, this is not complex. It's just a simple math of understanding order flow and open interest together. But you'll have to keep a chart open of an option. The futures, okay, do not show, okay, that kind of reduction even on a Thursday until, okay, it's the end of the month, of course. But every Thursday, whichever, okay, option, okay, you're trading at, keep an order flow chart open, preferably, okay, a 30-minute on one side and a 5-minute chart on the other side to capture all the flows, okay, using order flow and open interest, right? So with that, guys, I sum up what has happened, okay, with the order flow. I've spoken to you, okay, about market orders. I've spoken to you about IBISS, which is the initiative buyers, initiative sellers. I've spoken to you about COT, which is the commitment of trade. I've spoken to you, okay, about VPOC, the volume point of control. I've spoken to you, okay, about the impact of zeros or zones of low liquidity or no liquidity in the market. I've spoken to you about open interest, especially, okay, useful in the options market, and especially on a Wednesday, Thursday, a Wednesday for the Bank Nifty, Thursday in a Bank Nifty. And I like to stress again, as I wind up, that all of these tools are useful for you, okay, to become very good in order flow. I'll be the first person to tell you that order flow is not simple. It's not easy. And anybody, okay, who's looking for an easy indicator to make money in the market, don't stop looking, because there isn't anyone. You have to work hard. And if you're willing, okay, to work hard, there is a path for you in the markets, right? The evidence is there always in the information, and the information is given to you so that you can monetize it, provided, okay, you look at the right information and in the right charts, right? So I hope, okay, with this, all questions, okay, about order flow will be clear. We'll wind up, okay, this series. This is gonna be on YouTube. Thank you for joining me through these past 3 sessions. I've enjoyed, okay, bringing this to you, bringing this series to you. We are open on support@vtrender.com or charts@vtrender.com to answer all your questions related to the market profile, related to the order flow, related to options flow also. And keep those questions coming in, okay? It helps to know, okay, what you are all thinking and how you are approaching, okay, your trading businesses. But we've done through this learning series is to project and show you what order flow can do to your trading. And I do hope, okay, you find it useful. For some of you who are new to the concept, you will require more than one hearing of this, but give it time, okay, as we start, okay, a new year from in about 15 days from now. I do hope, okay, that you get good at order flow and you make order flow trading a part of your daily routine, because it's that one chart which is going to give you every single thing you need to know about the market, right? So with that, let me sign off, and thank you for joining me again, and I'll see you around. Okay, thank you, guys.